Welcome to the Business of Property podcast. I'm Simon.
I'm Stuart.
And I'm Simon.
We're all property people running our own businesses, and this podcast is just us chatting every week about the reality of anything and everything property. Now, I didn't get very confused and intro myself twice in that introduction. We are, in fact, joined by another Simon, which is brilliant because it's obviously an excellent name. So I'm sure this is going to be an excellent conversation with two Simons in. Simon is joining us as a mortgage broker and mortgage expert. And I think I'm just going to hand straight over to you, Simon, to tell us, first of all, the big news from the Bank of England last week.
Yes, good morning. With the Bank of England rates going up yet again last week, which was kind of expected, we have seen quite a push in the market again, or inquiries have jumped up because people are obviously concerned that rates are going to up, concerned that lenders are going to be pushing rates up again. They're withdrawing rates, lenders, very quickly with very little notice. So concern is there, obviously, moving forward. Portfolio landlords are then concerned with cash flow moving forward over the months, the coming years, because one thing we can pretty much be certain about is the rates are not going to come back down again.
And you just reminded me of a topic that Simon and I talked about recently. And one of them was the speed at which some products are getting removed. And anecdotally, we've seen a few people coming towards the end of, a completion on a purchase where mortgage products have been removed. And we felt primarily because of the rate changes. And you and I spoke off record, Simon G, about that. And is that something you've seen quite often in the last few months?
Yeah, I mean, there is a sort of a little bit of confusion in the marketplace that when products are withdrawn from the market and you have a mortgage offer or you have an application in place, pretty much all lenders, I would put that sort of caveat across the board. If you have an application in place, you've booked that rate, so you're good for that rate unless something drastic changes within that application. That's secured up until that point. So rate withdrawals are only really a concern if for clients who are thinking about it. You're not sure, you're not quite sure what rates you're looking at. You haven't found a property yet, you haven't put an application in. The problem is yes, the lenders are giving very little warning. It's most of the time, I would say it's probably 24 hours. And by that time, it's very difficult from our side of the fence to then notify everybody who's just made an inquiry, possibly saying, well, I'm looking around, I'm looking at rates, you've given them quotes to go out and have a look, to then get those applications in, because just sheer numbers. And clients are then not, it's not publicised to the marketplace. It's generally publicised to us that rates are being withdrawn. But you can secure them. I mean, by putting an application in. I mean, there are ways, and we can get around it as much as we possibly can, and we try and help people to do that.
So I guess what I'm thinking is then maybe banks would typically be a little bit more flexible if a mortgage offer's expired, for example. So, I don't know what a typical time period is, but let's say it's 90 days.
That'd be normal, yeah.
That they might be more flexible. If you're purchasing a property, say, okay, yeah, if we all know conveyancing can take forever, and then extend it. Whereas maybe now they're not being as flexible because they know their rates have got to change. So if an offer has expired, they're not going to stick to that anymore. They're going to say, no, actually, we've got a new rate or a new product.
Yeah, I mean, there isn't a standardised system with lenders with regard to extending offers, which is certainly annoying from our side, because you touched on offers expiring. Offers would normally expire, you're quite right, Stuart, in 3 months. Some will go to 6 months, rarely, but some will. So you have to get these things completed in that amount of time. Now, and that normally would be in a normal, pre-COVID days, that was very, very rarely an issue unless the chain broke down a couple of times. But we're noticing that going on now, and these things, purchases are standardized taking 4 or 5 months, which is completely different to pre-COVID. So we're constantly going back to lenders and getting offers extended, and some will, Some will only go extend for a couple of weeks. Some are great and will then put another month, 2 months on the offer. It's something I would say to people, if you are looking, it's on your to-do list when you're looking at mortgage lenders, when you're speaking to your broker or you're speaking to the bank or whoever you're applying on your behalf. Have that as a tick box to ask the question. It's not just rate. Hugely at the moment it's service, because that's dropped off massively. But it's right, okay, well if this purchase does drag on, can I get this offer extended? And more importantly, can I keep the product? Because as we're seeing at the moment, fixed rates are increasing, and that can change someone's cash flow hugely. I had one just recently which has dragged on, and it's gone up just under 1% in a couple of months on a particular product. It was quite specialist. It wasn't residential, so it's a different, quite a little bit of different market. But that then has a huge effect on cash flow. So you've got to. It's something now people have to be aware of, and it's definitely a question you should ask.
You mentioned in there service levels have been a bit of a problem of late. What do you mean by that? Can you expand a bit?
Yes, it's a nemesis at the moment. Service levels, both from a lender point of view and on the solicitor side. So, for example, and this is pretty much across the board. There are a couple of high street lenders, as we would all know, who are okay at the moment, and they're picking things up a little bit slower than they were, let's say pre-COVID times. It's the easiest sort of timescale to sort of compare to, where they would normally, you would expect to put an application in within the week, you would expect it to be underwritten and looked at, requesting your documentation to be sent in by the broker and then out to valuation within a week or so. That's very sort of general, but that's a good guide. At the moment, some of the high street lenders are taking 3 to 4 weeks just to pick up that application. So if that's sometimes with something like a remortgage, it's not as important, but with a purchase, if you're in a chain and you have that sort of service levels, or you're expecting that sort of service levels, the chains can break down very, very easily. And that's why I sort of touched on earlier. That's why we're seeing, I would pretty much, historically, I'd pretty much put my house on the fact that nearly every purchase takes 12 weeks. It's just, it's amazing how that happens. In my 20 plus years of doing this, it's pretty much standard. I mean, if it's a very small chain, a couple of solicitors dealing with it, you can get it in 8 to 10 if you really push. But realistically, if everybody looks back, it's 12 weeks. Now, that is being pushed back at least another 4 to 6 weeks. And that's down to, first of all, lenders are painfully slow, and some of them obviously worse than others. But then it then goes over to solicitors. Some of the solicitors, and they have been, they would say, I'll be careful here, but they've been still using the excuse, as it were, that they're working from home. Well, my opinion is they're all working from home. We've all been working from home. We've all changed how we work, and we have done for 2 years. Surely you've adapted by now. I don't quite get that. If it's volume, well, my opinion is don't take the work on. That you've got to make people aware, because certainly, as you guys know, when you're buying a property, even for an investment or for residential, I do find residential is that people are a little bit more emotionally involved. But even for investment purposes, because you're looking at the bigger picture, it's a business. So therefore, you want that to go through as quickly as possible. And if you know there's a lender, again, as I go back, it's something else. You've got to ask the solicitor, what are your service levels like? How quickly can you come back to me? And a lot of the people, unfortunately, a lot of people will use what I would then compare a solicitor sweatshop, in that they're conveyancers, they work on volume, and they get these things through as quickly as possible. And if they've taken on too much work, you will sit in a pile and you won't have any direct access to people. Not all of them, don't, that's not everyone. And some, if you pay for it, you will get the service clearly. But check them, ask the question. You've got to ask the question of your solicitor. Will I have access? Will I have an email? Will I have a phone number? Is that phone number not a direct line into you? Will I get a case handler I can talk to on a daily basis and not wait a week or two to come back to me? And which is key. And some of it even worse for people is, it sounds like doom and gloom, but even worse is the fees-free solicitors offered by lenders, mainly by again, I say high street. So most people will know what the high street lenders are. And they've obviously created a deal with these solicitors to say, right, we'll give you X amount of business and you will do this on behalf of our clients for next to nothing, I would imagine. And you get that type of service. And I've had a couple of cases recently which have gone on very standard remortgages, which have gone on 5 or 6 months. So then for us, we are then looking for offer extensions. They're then not extended. They won't extend the product. And it's not down to the client. The client said, well, I've sent everything in. So you've got to make sure the fees-free legal service provided by some of the lenders, ask questions. It's not all what it may seem at the moment, and it may be. So quite a lot of these lenders will, instead of giving you fees-free, will give you a cashback. Now, again, not used very often historically, but now I would suggest you look at that option, and then you have a choice of going out to other conveyancers who 9 times out of 10, these are very simple. So we'll do it very cheaply, but you will be able to get the service, because why risk losing the product in a market where rates are going up all the time?
I think I agree completely with you. We've all been working from home for a long time now, and you can't use that as a good excuse. And there was a lot of transactions going on in the property world while stamp duty holidays were a thing.
Yep.
At the crunch points at the end, and then for a little while afterwards, obviously, because things overflowed. But that has calmed down a lot now. And while the market is still busy, it's nowhere near as busy in terms of transaction numbers as it was back then. So you mentioned that you think solicitors are still taking on too much and complaining about working from home. I'm not quite sure how that works. But you also said that the lenders are slow as well. Do you have any idea why they're working so slowly at the moment?
Yeah, that's from what we're told. As brokers, we have sort of access business development managers, which we deal with, and some obviously we've had relationships for many, many years. So there's a lot of trust there. So you tend to believe what they say rather than the general spiel the lenders give out about whatever the service levels are. And it's volume. It's pure volume. People are now coming off, generally it's remortgage volume. So and some have had 4 or 5 times the amount of applications in on any 1 week that they would normally get. So we're seeing definitely the purchase market has slowed down. We can see that by stats coming out, being sent over to us all the time. So that was kind of expected, and we could see that anyway. Although the demand is still there, property is just not on the market. You guys have probably seen it yourself. I mean, we're all there. Everybody's still looking. Every client of mine is still looking on Rightmove, etc., every day to see what's popping up. And there's not a lot. I mean, if you look in your own, wherever you live, which is sort of the common thing, just to keep an eye on your property prices, not a lot is certainly coming up in where I live, and hasn't done for a while. And it's the same all over. I've got lots and lots of clients sitting there, and many of them have sold because they don't want to lose their buyer, sitting in rented and waiting. And they're waiting and waiting because they're just not the right property, or properties are coming up and they're overpriced. So it's really, sorry, going back to that, it's really the remortgage market. The remortgage market, people are sitting on standard variable rates, or they're very close. I'm getting a lot of calls at the moment saying, Simon, we had a really good 5-year fixed rate 2-3 years ago. Can I get another one? well, yes, you can, but you're going to have to pay a huge early redemption charge. But that, I'm going back 10, 15 years. That was the case back in, stick my neck out here, guys. I want to say sort of 2004, 2005, where rates were going up again, and it was more cost effective to pay an early redemption charge and lock into another fixed rate, knowing that rates are just going to increase, or expecting rates are going to increase somewhat over the coming years. So therefore, we'll suffer the early redemption, so get back on another long-term fixed rate. So that may happen again. I've not seen it with a client as yet because rates are still historically relatively low. But the remortgage market is buoyant, and that's where all the business is coming. And that's why all of us, and if you think a lender, I was speaking to one particular lender who usually expects about 500 applications a day, and they had 2,500 in one day. So if that's just sheer volume, and they've got to process those through, and someone has to physically. I still think the whole process is antiquated. I was trialing an application process that went to virtually immediate offer back in, it was sub 50% loan to value back in 2004, 2005. 50% loan to value, perfect credit. There's an argument there to say that some sort of technology should be able to check enough information to make that an option again. Why is it taking weeks and weeks? Why does someone have to look at an application in that much detail at that loan to value? There's an argument there. We digress.
Yeah, well, yes and no. I mean, you've got me thinking about, the banks, and part of my brain is almost trying to defend them slightly, saying, well, I imagine since the financial crisis, etc., they've got to be on the ball a lot more, given their penchant for, the subprime loan that got us into the financial crisis of 2008. But of course, I don't want to defend the banks, because what you've just brought together two of my favourite subjects, and when I say favourite, I mean my pet peeves, is the service levels and fees. And I've seen this. So we did a further advance. We kicked off the process in October of last year, and I think the further advance completed around April. I can't remember the exact dates now. So that was bad enough. But so service levels and standard variable rates was the two subjects you got me thinking about. And I've had two mortgages come up where they've both gone into the SVR, the standard variable rates. And on one of those, we paid for a valuation. I know, so you've dealt with one of them. And actually, I think on both of them, we had to pay for valuation fees. The bank in question took so long, and they still haven't completed it, by the way, but they've taken so long, they then said that we need to repay for another valuation because the old one had expired. And obviously we said, well, we'd provided you with all information on, day one. The only reason that's expired is because it sat with you. And, that's now been bouncing around for, I'm going to say 3 months. And it's now got to the stage where we're also questioning the fact that because they've taken so long, we're paying the SVR rates. And, I think we're on about 8%. We're almost on sort of bridging lending terms. I mean, it's so high, as you know, and these are the HMO products. So we're probably paying 3 percentage points higher on an SVR, as well as all the fees. And I guess, because part of me wants to defend them, I say, well, okay, if you've got an operation that's going to get 2,500 inquiries in a day, then, you've got to create the systems and processes to deal with that, because that's your job.
Yeah, absolutely. They keep the issue of the lenders come back to us and say, well, we're trying to create systems, we're trying to put these things in place. It's very rare that a lender comes out with a new platform for a broker that helps us or makes things any easier than it was 10 years ago. Very, very few lenders have changed their broker platform where we go on and apply for mortgages on your behalf. Very few of them have changed over the last 10 or 15 years. I mean, maybe the back office has, but in my eyes, the back office has become more difficult. And you touched on it there, Stuart, which was a really good point. Actually, you go back to, we've got to remember, and we're we're very good at forgetting about the banking crash and what happened and people queuing outside Northern Rock to get their money out and things. So I do appreciate that. But it seems like all common sense has just disappeared out of lending completely.
So my question for you, Simon, because obviously you deal with business development managers directly that obviously sit inside these banks. What's the current view for them? I mean, is there a level of apology from them, or do you feel like this is the way it is? Deal with it. What sort of sense are you getting from via the BDMs in terms of the banking?
I mean, you've got to remember these people they're there to sell the company. Most of them are very technically good on criteria for each individual lender, and as you know, lenders will have a vast array of different criteria to meet people's needs. Generally speaking, they've got their head in their hands and they're just going, sorry, I'm so sorry. I know, I'll do what I can. And I'm sure I'm talking on behalf of pretty much all brokers across the country. We've all got cases that are urgent, that need to get over the line. And you guys would know again, I'll go back to when you're buying a property, you then become emotionally involved in it. So and for most people, let's say who are not buying it on a residential basis, you've got the pressure going from further down the chain. You've got pressure from up the chain. Everybody wants to know where your valuation is. Everybody wants to know why you don't got the offer. The estate agent wonders why you can't exchange within 7 days. So we're all going to the BDM and saying, look, I appreciate you've got lots and lots of work. So have we, but we pick up the phone. We will talk to the client. We will say, sorry, we've got, the service levels are bad and we're trying to put it. But a lot of clients don't realize that or want to hear that, quite frankly. They want to say, well, this is important. I'm being pushed for exchange next week and we haven't had a valuation out. And it goes, unfortunately, you can escalate these things with a lot of lenders. And trouble is every case is important. Everybody thinks their own application is the most important and for good reason.
Yeah, of course.
So it's very difficult from their point of view. They're doing all they can. And I suppose the argument is you can't just, from a bank's point of view, if all of a sudden you have 4 times as much work as you had previously, is that an error in their system? Is that processing they need to look at? They can't just employ more people because it takes forever to train them up, and particular underwriters, etc. So it's some BDMs are really, really good and will get a hold of it and take it through and literally grab the application and take it to whoever they need to and get these things through. Unfortunately, the bigger, let's just say bigger lenders, it will go into a processing center and, good luck with it, really. It's unfortunately, it's as harsh as that.
One thing I'm thinking about on this, Simon, is how this is benefiting the rise of the developing finance / bridging finance, because I know some of their rates are starting to come down as well. And one thing you do know you're going to get, okay, fine, you might pay anywhere between 0.7 and 1% per month and entry / exit fees. But one thing you do know is that you're going to push through a product and a purchase fairly quickly. Are you seeing anything on your side that sort of demonstrates that more people are gravitating towards development finance for that reason?
Really good point there, actually. The bridging market is booming. There's no doubt about it. A lot of new bridging companies coming on. Rates are really good. And what you tend to have is you'll have someone you can ring into, call into, email into. You'll have a direct contact. So what do you need from me? What do you need from the client? We'll get that over today. We'll get it up to you today. What do you need? And they can get everything done very, very quickly because you have a point of contact. And I think that's with anything. If you know you can get through to someone, you know you can speak to them directly, you can talk things through, you get things done so much quicker. Now, there is I'd have to be careful on how quick you can get these things through. Bridging, a lot of, historically bridging was, right, okay, I need this by the end of the week. And bridging would happen literally that quickly. Now, don't be wrong, there will be cases which are ridiculously quick and can happen like that. But generally speaking, they will take a number of weeks as an absolute minimum. They still have to go through a lot of the standard legals, still have to get valuations done. There's still information that still needs to be provided. But it is generally quicker, and the market is booming. Certainly on the more and more lenders are then willing to do day one remortgaging. So what I mean by that for everybody is that you buy, and you may buy via bridge or you may buy via cash. A lot of developers, landlords, portfolio landlords are buying cash at auction. And so a lot of auction properties coming up at the moment, surprisingly enough. And then what they're doing is we're going to lenders and saying, right, okay, can we remortgage day one or as soon as it's purchased? So the client knows they've got the property nice and quickly. They don't have to wait for the poor service, which is provided by the lenders at the moment. Hopefully that will improve. And then a lot more lenders are looking at that. That's becoming big in the marketplace.
Yeah, very good. And are there any other products that you've seen come to the market recently that you think are worth just mentioning it for the listeners?
Self-employed, a question I get asked a lot, self-employed 1 year's accounts, or can we rely on just 1 year's accounts for whatever reason, particularly in COVID? You notice lenders will, in the middle of COVID and just coming out, they were really hot on how did the company perform? What did it do? How did you cope? Were all your employees on furlough? They're not so stringent. We're noticing at the moment they're sort of coming back, so which is good for the borrower. And certainly looking at, if you just want to look at 1 year's accounts, whereas previously the rates, if you only wanted to do that, the rates would shoot up. So you'd pay circa 2-3% higher than a standard rate. Now they're very competitive. Let's say that, compared to others on the market, if you were having like a standard high street rate. So you're not being penalised as much, which certainly helps. It's the first time I've seen for a long time that lenders are trying to help the self-employed, and actively trying to help the self-employed, which is a good thing, because it was certainly heavily weighted towards an employee, PAYE.
You mentioned some COVID effects there, and not that long ago, we were hearing lots of sort of negative impacts from people and businesses that had bounce back loans and CBILS and stuff. How are lenders reacting and coping with that sort of element of things these days?
Lenders would generally want to know about them, but we're definitely seeing a change in attitude, and they're appreciating what people have gone through. They're definitely taking on board. That is, I'm contradicting myself here a little bit, but whereas it's not, because it's not an automated process, underwriters are then looking at that and just wanting an explanation. Why was this? And generally speaking, you would like to think that we've already looked at the client and see how they're doing, how the business is doing, so we can take a view on it. And then introducing them to the lender, we'll already have the reason behind why, and if they were affected by COVID. Most people, I would say that, put my neck on the line there, but most people were affected in some way or another. And it was all very easy for an employer then to put staff on furlough, take all the benefits they could, whether they needed them or not. An awful lot of people we're seeing just took them anyway. And lenders know that. And then they just want to see. So they're doing things like looking at more bank statements, for example. So send over 6-12 months business bank statements, and then they can see that, oh, right, yeah, actually, they're trading, the trading figures are really good again. So we'll take a view on that one, which common sense lending again. That just makes sense. Of course, that's all you have to do. It gives you a very good picture of or more information as to making a lending decision. So yes, that's definitely good going forward.
So sort of the same question, but with a different focus. How about people who have taken mortgage holidays, particularly investors who decided to take mortgage holidays during the period? How's that being viewed?
Personally, had very, very little issue with it. So I haven't seen it coming up on, it doesn't show, okay, put my neck on the line here, but from what I've seen, and we see a credit report on every client comes into us. If they've taken a payment holiday, it doesn't show on their credit report, so that is then not picked up. The lenders, as a whole, will not ask certain questions, because if you think something like that then has to be built into their system. They went through a period of asking that after, once the application's gone in, they had a lot of lenders then came up with a lot of general questions about COVID. They're not doing that as much now. They're not asking those questions. They're not concerned. They know most people, a lot of people did take a holiday, and for good reason, because it was the unknown. And I think lenders, thankfully, in this situation, have actually said, look, well, most people are in the same boat. They took a holiday because of the uncertainty going forward. Fine, it's not an issue, and that makes sense. I mean, if you've not missed a mortgage payment in 10 years, you're just taking a holiday because of the situation we're in. Why should that change your decision?
Yep. So changing the subject a little bit, and conscious that we're starting to run a bit long, so try not to ask you too many more questions, but I do have a few still. And one is around these gradually increasing interest rates. The Bank of England has increased rates for the last 4 months in a row. Have I got that right? I don't know, something like that anyway.
I have to double check, but I think you're around about there.
So what sort of impact are you seeing from that? We've mentioned already that lenders are increasing the rates, lenders are pulling products sometimes at short notice. But for your customers, are you finding that some of them are now hitting the point where they can't get mortgages that they might want and things like that?
Not yet. I still think we're at the point where, because rates are still historically low. I mean, we're noticing on a residential basis, 5-year fixed rates are north of 2.5% now, depending on loan to value, of course, but that's sort of a general figure. And so they're still very, very low. I think the expectation is certainly within the industry that the rates are going to continue to rise. I think we would all expect a base rate to be around 2.5-3% is a realistic figure. We don't know that, of course, but from what the experts say and the Bank of England's indications are. So therefore, we're then going to be expecting 5-year fixed rates to be up around the 4.5% mark. I think at that point, people will then think about what they're doing. Think about, am I going to move? Am I going to be able to pay for this? Am I going to be able to, the usual pay for the living expenses, which of course that's got to be factored in now, because general living expenses have risen so much, and not hit a lot of people. I don't think they'll hit a lot of people until winter, and all of a sudden we're going to have these huge, great bills, and people think, well, my mortgage is likely to go up by, I don't know, hundreds of pounds a month. So is my gas, so is my electric. So I think that may have an effect on the marketplace. But of course, it doesn't stop things like remortgaging. You only have a fixed rate for 2, 3, 5, sometimes 10 years, but they're fairly rare. So when they come to remortgage, you still have the same issue. You can't go backwards. You'll still have to have one of these rates and look at them anyway. They're not, it's kind of the other way around, Simon, actually, where people are wanting the rates at the moment, because I think the knowledge of the person, the clients we have, is a lot better because of communication, social media, whatever. It's all there. It's all straight in front of you. That they're fairly aware that rates are going to continue to grow. So let's get on them now. It's just a case of, well, how much further are they going to go up?
Indeed. Nobody knows for sure. Say no if you want, but I was wondering if I could do a sort of quick fire round. And I know you can't name specific lenders, and I know you can't name specific sort of figures, and it will vary for every individual. We're not recommending or selling anything specific here.
Yep.
But if I sort of name a quick scenario, can you give me an idea of the kind of interest rate we're currently looking at for that sort of thing?
Yeah.
So if we're looking at sort of a first-time buyer getting into the market with a fairly small deposit and hence high loan to value, what sort of rate are they looking at?
2.75, somewhere around that. Again, it's going to be heavily weighted on deposit.
Yeah, of course. Yeah. Okay, then a residential buy-to-let investor coming in at 75% loan to value, first or second purchase, so they're not big portfolio or anything. What sort of rate are they looking at?
You're probably looking at something slightly higher, 2.95, somewhere around that sort of figure at the moment. We're just starting to see those creep over the 3% mark around and about, but you should still get something around about the 2.8, 2.9% mark at the moment. 5 year, I'm talking about 5 year fixes at the moment because they're certainly the most common.
Yeah, good clarification there on the fix and the fixed length. Okay, then so sticking with probably 5 year fix, stepping up a little bit. So if you're looking at someone who's buying in their own name but they've got a larger portfolio, what sort of rates are they looking at?
Probably something similar. A lot of lenders will not change rates, whether it's just a one-off or if they're a portfolio landlord. Some will, and they'll make it you can probably expect about 0.25% higher. So I would say you're probably looking at about just over the 3% mark would be expected at the moment. Slightly higher again if it's I would go probably say about 0.5% higher again. So you're looking at 3.5, 3.75 if it's limited company or limited company HMO.
You've preempted my last
one.
Right. So that's fantastic. We are definitely out of time now, though. I think it just remains for me to say thank you very, very much, Simon, for sharing all that fantastic knowledge. If anybody wants to get in touch with you, how can they best do that?
Jump onto our website, www.jsiassociates.com. All our contact details are on there, all of the team and myself. Give me a call, drop me an email anytime. Very happy to talk to anybody who needs to. Thank you for your time, guys. Appreciate it.
Thanks, Simon.
Cool. So it just leaves for me to say, again, a final thank you to Simon for joining us and sharing all that fantastic mortgage knowledge. Thank you very much to everyone for listening. If you've got any questions you'd like to point at any of us and we can pass them on to Simon, or you can direct them at Stuart and myself, please do get in touch either via the contact form on thebusinessofproperty.com, which is also where you can find show notes, or via Biz of Property, that's BIZ of Property on Twitter. Stuart and I are both on there and very happy to chat and answer any queries. And we will also join you again next week.